Hi guys, welcome back to TipRanks. My name is Annika and we love to hear what you guys think of different stocks you're looking at and your opinions on the market sentiment. Now, recently, there has been a lot of turbulence in the markets. We've seen a lot of stocks as well as cryptocurrencies in the red because of the new COVID-19 variant that has come about. Now, many people think that this is a bad thing, but actually, I personally think it's an opportunity to buy the dip because most of the stocks and cryptocurrencies across the market are at discounted prices. An example is in this graph. If you take a look at this graph, US retail investors rush to buy Omicron-triggered dip. As you can see, over the years, the stock market has shown consistent returns, and it's always tended to head towards the upside, especially when we talk about fundamentally good stocks. Now, this is a dip that investors are aiming to take advantage of because once the spread of the variant decreases, it tends to be that the stock market ends up following and going back towards the upside. In this video, we're going to look at 3 buy the dip stocks that can help you take advantage of this Omicron dip in the stock market. The first stock is ZNGA, and its ticker is ZNGA. ZNGA is a mobile video game developer, and they generate revenue through mobile game downloads, advertising services, and in-game sale of virtual goods. The global mobile gaming market is expected to grow at a compounded annual growth rate of 11.5% between 2020 and 2027. The current price for ZNGA is $6.21, and the analyst rating consensus deems it to be a strong buy. The analyst price target on ZNGA is $10.58. This is a 70.37% upside based on 13 Wall Street analysts offering 12-month price targets. As you can see, ZNGA has a range of games that many know: Star Wars Hunters, Farmville 3, Goal Rival. They also exceeded expectations in their Q3 2021 financial results. They expected to have a revenue of $665 million, but they actually had $705 million. This is very positive, especially when it comes to investor sentiment. Their revenue was actually up 40% year over year in Q3 2021. However, they did show a net income loss of $42 million. The SMART score for ZNGA is a 9 in that it is very likely to outperform the market. Analyst ratings are a strong buy. However, TipRanks investors are very negative. Blogger opinions are bullish as well as having bullish news sentiment. Hedge fund activity has increased by 10.1 million shares in the last quarter. And the return on equity is also negative at negative 3.09% for the trailing 12 months. But taking a look at the stock price for ZNGA, back in May 2017, ZNGA's price was a lot lower at around $2.54. And then across 2019 to 2020 and also around 2021, we saw the ZNGA share price increase drastically. And this dip is a very good opportunity for investors on a fundamentally fantastic mobile gaming platform. The main risks for ZNGA come from finance and corporate. 17% come from tech and innovation, and 15% from the ability to sell. ZNGA has acquired many throughout the years. They had acquired Chartboost in 2020, a leading advertising platform with 700 million monthly users. They had also acquired StarLark, which is a mobile game developer from China. These acquisitions have helped significantly contribute to ZNGA's top-line growth. However, the recent stock market dip comes from rising inflation as well as the Omicron variant, which is why we are currently seeing a decline in ZNGA's price, which could be a fantastic opportunity for investors. The second buy the dip stock is Vale, and its ticker is VALE. Vale is based in Brazil, and it's the world's largest iron ore producer. They also produce vital raw materials for steel making. The bulk materials division, mainly iron ore and iron ore pellets, accounts for most of its earnings, but Vale is also the world's second largest nickel producer as well. The current price for Vale is $13.39. The analyst rating consensus is a hold. The analyst price target on Vale is $16.28, which is a 21.58% upside based on 10 Wall Street analysts offering 12-month price targets. Eduardo Bartholomew, Chief Executive Officer, said that in this third quarter, our iron ore production was close to 90 million tons, with meaningful progress in the operational resumption of the Vargem Grande complex. We continue to work towards improving operational reliability, especially in the base metals business. Our cash generation remains robust, surpassing the last quarter by 18%, a pace that allowed the payment of historic dividends in 2021. We now announce a new buyback program which demonstrates our confidence in Vale's potential. By maintaining our value over volume strategy and optimizing costs, we will continue to create and share value with our shareholders. They reported an adjusted EBITDA of $7.109 billion. This cash generation that the CEO mentioned meant that Vale reported an exceptional dividend yield of 21.37%. This was around $1.54 per share. Dividends are a fantastic short-term hedge, especially when there is volatility in the market and falling share prices. The TipRanks Smart Score, however, is a 2 in that it is likely to underperform the market. However, this could be temporary, as analyst ratings deem it to be a hold. But TipRanks investors are very positive and blogger opinions are bullish. News sentiment, however, has been bearish. Hedge fund activity has also decreased and technicals have been negative. But as we saw, dividends were very high. Fundamentals show that return on equity was 52.84%. However, taking a look at the stock price chart, we can see that the price growth has been steady overall across the years. This is a fantastic entry point for investors given the historic prices. The highest risk is finance and corporate, with 24% in that segment. The second highest risk is in production, with 24% as well. And they also have another 24% of risk in macro and political. So those three are tied as the highest risks. The third buy the dip stock is PaySafe, and its ticker is PSFE. PaySafe is a London, UK-based payment platform that operates in various vertical markets. This includes payments processing, digital wallets, iGaming, and e-cash. The current price of PaySafe is $3.56, and the analyst rating consensus is a hold. However, the analyst price target on PaySafe is $5.10, which is a 43.26% upside based on 5 Wall Street analysts offering 12-month price targets for PaySafe. PaySafe has processed 1 billion transactions. They're a global leader in payments and they serve businesses of all shapes and sizes across 120 markets, which is great diversification. They also have a focus on security as well as having connections that people need, from cards to banks to wallets to online cash. They satisfy the way most customers need to pay. As you can see, they have a diverse range of industries that they supply. Their third quarter 2021 financial results showed that the total payment volume of $31.1 billion increased by 19%. They also had a revenue of $353.6 million, which was a decrease of 1%. The net loss attributable to the company was $147.2 million, compared to the net loss of $38.1 million. Adjusted EBITDA was $106.4 million, and this also decreased by 1%, similar to revenue. But otherwise, they had a 50% year-to-date revenue growth in North American iGaming. They also expanded partnerships by having Fubo Gaming, PlayUp, and Superbook Sports. They also rolled out Skrill USA digital wallet with a revamped design. They've also expanded their eCash partnership with Incom. They also acquired German fintech company Via Fintech, as well as the acquisition of Safety Pay and closed acquisition of Pago Efectivo. They also exceeded their cost-saving program targets, delivering $26 million year to date. The TipRanks Smart Score, however, is a 2, in that it is more likely to underperform the market. Analyst ratings deem it to be a hold, and TipRanks investors are very negative. But blogger opinions are bullish, despite news sentiment being very bearish. Hedge fund activity also increased by 2.5 million shares last quarter, despite technicals having been negative. Return on equity was also negative at 10.11%. The main risks for PaySafe are finance and corporate, with a whopping 83% in that segment. The rest is in legal and regulatory, and then production, with very little in tech and innovation and macro and political, which gives us the indication that they have no lack when it comes to fundamentally good technology and innovation, which I believe is the main fundamentals behind the business. So guys, those are my top 3 buy the dip stocks. Leave in the comments what you guys think. We love to hear from you. Let us know your opinions and what you guys think of the market sentiment and what your strategy is with your portfolio. Remember, this is not financial advice. Also, if you made it this far, don't forget to hit that like button and that subscribe button and that bell notification so that you get informed on when TipRanks releases a video. I'll see you guys in the next video. Bye!